How important are price actions in the financial market? In this video, we will be looking at how price actions influence market movements. This is a New Zealand dollar and USD market chart. Study this chart carefully. Prices reacted to this support level. Here, it formed an engulfing pattern and triggered the continuation of price movement in the upward direction. Price reacted here as well, resulting to indecision in the market and subsequent reversal of price. Here as well, the break at this level here couldn't be sustained. A powerful morning star is formed here. Here, the support level acted as a resistance level as prices moved below it. Now, we will look at a very important analysis when it comes to the financial market. This will define how successful you become as a trader. When you pay close attention to these candlesticks, where and how they formed, it will be easier to predict the possible market direction. Thus, entry levels, our focus will be what happened below this resistance level. Remember, an engulfing pattern is a very powerful reversal pattern, and this happened close to the support level. This highlight box is to note the distance of the pattern from the resistance level. The first important thing to note is the reaction of prices at support levels is vital to any analysis, as well as how close they react to it. The formation of candlesticks of small real bodies after this caused indecision in the market. Note, the strength of the engulfing pattern diminished. This is because it didn't form close to the resistance level. A good harami pattern formed at the same level as the previous pattern, but there was no confirmation candlestick. The distance here greatly influenced the effect of these patterns. Prices couldn't go further down, but reacted at this same level, forming an engulfing pattern with price rejection, distance from the resistance level. Prices went higher and reacted at this level, and this triggered a good sell signal. Any action must be taken at the close of this pattern. The sellers took control of the market, forming a long bearish candlestick, and this was an indicator that price would continue lower. A good scalper would definitely seek selling opportunity from here, while an aggressive trader will go short from here, hoping to earn from further price movement. A sell entry will look like this. The stop loss level should be placed above the resistance level. The expected target will be the previous lowest low. Other good entry positions can be gotten by selecting lower time frames at the close of the pattern. This is on 1 hour time frame. Here was a good entry level. The reason being that prices reacted at the resistance level. Let's take a look at a short position. The stop loss level will be placed above the high of this candlestick. To get a good target level, you should always observe the higher time frames. The first possible target level should be here. Mark it out. Always make sure the target level doesn't surpass the previous low. This sell position has a very good risk to reward ratio. Remember, the reason for any analysis is to get the best possible entry and exit levels. And when you don't get these, you haven't done the best analysis. For traders that missed out on this entry, scalping from here would have earned you good pips from the market. You can also scalp from here. From here, prices went lower. The reversal of price didn't reach the resistance level. At this stage, there is something very important to note. A harami pattern was formed here, and prices moved lower. To an extent, the distance of price from the resistance level played a role. The places these reversal patterns appear in the market chart influence how effective they become. This good bearish candlestick after the shooting star is a very nice indicator that sellers are gearing up to take control again. Though the shooting star didn't form closer to the level, but it could have influenced downward movement of price. Price rejection here saw prices moving higher. What actually happened here? This long bullish candlestick indicated strong dominance of the bias, and the small bearish candlestick, which appeared afterwards, means the strength of sellers diminished. Suddenly, a longer bullish candlestick was formed. This maintained the dominance of the bias. Here, sellers couldn't ensure prices moved lower. The strength of these bullish candlesticks triggered the dominance of the buyers, and it will take a higher selling pressure to overturn this. The buyers here totally eclipsed the strength of the sellers. Take a look at this. This initiated both the commencement of a motive wave and a handle breakout. This completed the cup and closed the motive wave. Only a longer bearish candlestick could have overshadowed the strength of the bias. This also showed both price rejection and indecision in the market, and this is influenced by the previous strength of the bias, as shown.